All right, so welcome to another video. Today, what we're going to do is we're going to take a look at how to sell credit spreads in a bearish market, or a market that's trending down, or maybe one that you're a little more cautious about. So we're going to go ahead and take a look at that. Before we do, keep in mind, if you want to go ahead and have some specific questions about trading, you can go ahead and reach out to me. There's also things that I do when I work with people for a handful of months. You can book a 20-minute session and discuss that. So anyway, you can check these things out. But we'll go ahead and get started here, and we're going to go ahead and take a look at just overall market's been trending down. So if you take a look at the SPX, okay, you can see it's continuing to move down and lower. And as we continue on this trend on the downward, and if you've been selling credit spreads or anything, recently where you're trying to make some credit, the trends have been kind of a little bit more nasty and not so great. So this market is definitely a little bit more worrisome if you're selling credit spreads, or if you're a long investor and if you're dealing with options. Let's say you're selling vertical puts, it's a bit of an issue. So I want to share with you something on Adobe here that we're going to show you an example of how you might sell a credit spread here with this trends going down. This one just recently had earnings, and you say, hey, I want to catch a falling knife. I want to buy the dip, but I just don't know how to enter it. So if normally you go in and we go on Adobe, let's say about 40 days out, you might want to say, hey, well, instead of like 30 or 40 days, I might go a little longer. I might go maybe 49. Give yourself the gift of time, a little bit more time. The other thing is, as we go in and we sell these credit spreads, let's say we're just selling a $5 wide right here, and we go sell credit spreads. If normally you sell, let's say 10 of them, here we'll go right here. If normally you sell 10 of them, obviously you can go ahead and sell just 5. So if we normally sell 10, that's $4,300 worth of capital tied up. But you could just go in and say, okay, well, I don't want to sell 10 of them. I want to sell maybe just 5 of them. So you could reduce your size. That's one way of doing it. The other way to do it is you can kind of sell some on the other side over here and turn it into maybe more of a iron condor. That'll slow down your delta a little bit. So this way, if the market pops a little bit, you'll still be okay. But what you can do is, idea number 2 here, or 3, we can go ahead and sell a couple of contracts on the right side or the call side. So now as it pops, we're good. But if it pulls back, I'm less aggressive on it. Okay, so we basically went from a 14 delta to maybe just reducing a little bit. The other way that you can do this is go ahead and add an extra. Let's go back to our normal 10 contracts. The other way you can do this, let's go to idea number 3 here, is switch it to a custom trade. When you go ahead and switch it to a custom trade, we can go ahead and add an extra put right here. By adding an extra put, what it does, you can see it goes in and takes it from something like this to more something like this, where now if the market pulls back or the stock pulls back, I'm not in as much trouble. Now, can you still get hurt? Absolutely. You're just not hurt as much. Instead of cutting off your hand, you're kind of cutting off a little finger or a nail. So it's still painful, but it's not as nasty, right? So if you go in and do an evaluation of, okay, if this thing pulls back to 240, okay, you'd be down $308. But if you didn't have that extra put, you'd be down like $1,700. So that's a big difference right there, is when you're starting to nibble, you're adding that extra put. Okay, now you could combine this other strategy with it and also sell that, sell some calls on this end as well, to kind of now create a little bit more of a strategy where you're protecting a slightly iron condor in a way. And now that's even more protected. So those are a couple of ideas that you could do. I'm going to show you one last one, and that is to go ahead and do something like a diagonal. Okay, so we'll buy a diagonal, and this is usually a covered call alternative. And what we'll do is we'll do something like this, 285 here. So now if the stock heads higher, what we're doing here is we're creating some positive delta right here, but we've got a positive vega. So in bearish markets, this will help you out a bit, because as it pulls back, the positive vega will help. And if you're really worried, you could go in and just actually do a calendar. But when you do a calendar, you'll have to go maybe a little more bullish, especially if you're doing this in more in a long portfolio, simply because that positive vega will offset you a little bit. So you might do something a little bit more like this. So where it pops, you're kind of waiting, and when it pops, you're looking to take it off. But this is more cautious or conservative, because if you pull back, you're using a lot less capital here, maybe $500. Whereas if I do a rotation, like a diagonal here, the amount of capital is now $730. So it's a little bit more capital. So anyways, there's a few little trade-offs there that you can do just depending on what you're looking to do. And obviously, if you're very, very cautious, you could do a calendar that's maybe more right at the money. But the problem with that is if you get a snap up, it's not going to work as well. If you get a pullback, that's a different story. Then it pulls back, you're not as hurt. But the downside here is if it snaps up, well, now you're going to overshoot your price. And especially with a market that's been heading down, 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 if you get one day snap up, this thing will just kind of blow up in your face. So you're better off to do a calendar that's more out of the money. Even something like this, where if it just pops a little bit in one day, you're looking for something to just move in that zone, and then you take it off. So anyway, those are a few different 3 or 4 trading ideas to sell some credit spreads or different types of premium-based strategies in this kind of market and environment. I hope that helps, gives you some ideas and insights to these trades and how you might approach it. Obviously, there's many more things that you can do. Check out the website and links in the description, along with some other courses that are related to the topic. Thanks, and I'll see you next time.